In this week's video, we'll review the latest charts to help us answer the question, is it time to develop a stock market exit strategy? Since the primary trend has been so strong in recent months and the hard data tracked by the CCM market model has classified basically all volatility as volatility to ignore, we have not covered our bear market strategies or our migration strategy much in recent videos. And for CCM clients, understanding our basic migration strategy is very, very important to helping us sleep better at night. It's prudent to have a bear market strategy or an exit strategy for two major reasons. Number one, the losses can be devastating. SPY buy and hold lost 55.19% from the S&P 500's peak in October of 2007 until the market found a bottom here in March of 2009. Number two, which we will cover later in the video, the benefits of diversification can be greatly exaggerated. Some new data was announced on September 11th, 2018 that ties in nicely to the topics that we've covered in these videos in recent weeks. From CNBC, small business optimism surges to the highest level ever, topping previous record under Reagan. This is an excerpt from the report that can be found on nfib.com. The Small Business Optimism Index soared to 108.8 in August. That's August of 2018. A new record in the survey's 45-year history, topping the July 1983 high watermark of 108. Key takeaways here. Small business sentiment very, very similar to sentiment during the Reagan administration. Small business sentiment in the present day, very, very similar to sentiment in July of 1983. We covered this constructive chart from a probability perspective in the August 17th, 2018 video. In that video, we made the fact-based case that the present day is very, very similar to this point here in the 1980s. The new data that came to light this week ties in nicely. Reagan administration here, July of 1983 here. From a technical perspective, this point here in the early to mid 1980s is very, very similar to the present day. And that ties in very, very nicely with the data that was announced this week. And it also ties in nicely with the chart that we covered in last week's video, July 1983, Reagan administration here, and the fundamental data that was released this week also ties in with the video dated August 24th, 2018, that referenced the early 1980s, where we covered this long-term quarterly chart of the S&P 500 index. In that August 24th video, we said this point here, this point A, was very, very similar to this point A here, or the present day. The data that was announced this week said that present day small business optimism right here is very, very similar to small business optimism that was present during the Reagan administration and in July 1983. Thus, this point A correlates well with this point A, and this point A correlates well with the data that came to light on September 11th, 2018. You also may remember in the August 31st, 2018 video, we also tied the present day to the early to mid 1980s. And once again, that correlates very, very well with the data that was announced this week. Reagan administration here, small business optimism, very, very similar at this point here relative to small business optimism in the present day. In this video, we tied this point here to the present day as well from a probability perspective. Moral of the story, we continue to get more and more evidence that aligns with the theory that we should remain open to the distinct possibility that good things could happen for a long period of time. It's an excellent time to water test your portfolio or to test your exit strategy. Why? Because the markets are currently constructive. And when we have constructive markets, we can think clearly and make prudent decisions. Given what we know as of September 13th, 2018, the long-term outlook for the NASDAQ remains extremely constructive. September 13th, 2018, we still have a very constructive look for global stocks as well. The CCM market model tracks over 200 different ETFs, including individual countries, regions of the globe, and global indices. Just because a market breaks out of a consolidation box, that doesn't necessarily mean that's the best place to put our capital. The hard data has been telling us for quite some time to remain patient in terms of diversifying into foreign positions. And thus far in 2018, that's paid dividends. VU, the S&P 500 ETF, as of the close on September 12th, up over 8%. VT, Vanguard Total World, so this is global stocks, up roughly 2%. EFA, which is Europe, Australia, Asia, Far East, down roughly 4%. And emerging markets over the same period, down 12%. Not all try to be patient within the context of a bullish primary trend in the United States. Strategies are created equal, which is another way of saying not all pie charts are created equal. It's extremely important that we build a prudent pie chart based on the facts that we have in hand. Is it possible that emerging markets will start to close this gap? Absolutely, positively, yes. But we need to see evidence, improvement. We don't have that. Presently, the gap is getting wider. When will we consider adding these types of positions back to our portfolio? When the data says it's prudent to do so. And like everything else, we'll take it day by day. We have absolutely positively no idea if and when these type of positions will be added back to the mix. We're more than happy to do it when the data supports that chess move. In the present day, stocks from this point to this point rallied for about 8 years off of a major low. From this point to this point, stocks rallied for approximately 8 years off of a major low, and then went on to rally for an additional 17 years, telling us to keep an open mind about better than expected outcomes in the days, weeks, months, and years ahead. That's a probabilistic statement based on the facts that we have in hand on September 13th, 2018. In last week's video, we showed that the present day S&P 500 as of September 6, 2018 looked a lot more like these constructive periods which featured favorable odds. To help us sleep better at night, let's talk a little bit about how we will handle a shift like this, where we go from favorable odds to unfavorable odds. And since the big picture looks very, very constructive, we don't want to spend a lot of time on this exit strategy topic. We can cover it in more detail in the future when the odds and data start to deteriorate in a meaningful way, something that has not happened yet during the entire calendar year of 2018. If you're watching at home, you might logically be thinking, well, I'm in better shape than this because I have a diversified pie chart or a diversified approach relative to growth. That's a logical thought, but as we move forward, we're going to make the case that it's also prudent to water test that thought while the markets are still healthy. You can find detailed information about these topics on our website by clicking on the FAQs. Here's one real-world example. Logically, you would think that if we built our portfolio in a diversified manner using large cap, small cap, REITs, foreign large cap, foreign small cap and mid cap, and emerging markets, that this type of diversification would help us in a bear market. And we're about to show why it's extremely important to take your present day pie chart and water test it like this. How did this portfolio perform during the financial crisis bear market? The diversified portfolio actually lost more than buy and hold SPY. Is it possible that your portfolio would have held up better between point A and point B? Absolutely, positively, yes. However, it's prudent to water test that now. Another reasonable and logical question might be, what happens if I have bonds in my portfolio? In this case, bonds would have helped. It would have mitigated the damage. However, as shown here, any part of your allocation, for the most part, that's related to growth or stocks would have been hit hard. Thus, it's still prudent to water test it by checking to see how your pie chart would have performed. The other consideration about having bonds permanently in your pie chart is it's very, very possible that they're going to continue to be a drag on portfolio returns. Bonds have been significantly underperforming stocks recently, and you can make a logical case that bonds could produce very disappointing returns for years to come. The factual case relative to the susceptibility of bonds and the limitations of an I need income approach can be found by Googling Shavako and YouTube and looking for these videos in the list of videos that appears on the Shavako Capital channel. You can find all the videos by clicking on the word videos. Now we're going to use a weekly chart, SPY relative to TLT, stocks versus bonds, to illustrate basic and generic concepts about bear market strategies and portfolio migration. October 9th, 2007 is the day the S&P 500 peaked. These are generic weekly moving averages tied to the stock-bond ratio. These figures here are based on the market model in its present form, which includes the screens that were added in May of 2017. July 20th, 2007, before the S&P 500 peaks, 100% exposure to growth, 0% exposure to conservative ETFs. If we fast forward to July 24th, 2009, so this is after the bullish transition has already started, the model is back to 100% growth, 0% conservative assets. This is the important portion of the chart. Between this point A and this point B, SPY drops 55.19%. Obviously, if we maintained a 100% exposure to growth and a 0% exposure to conservative assets, even if we were highly diversified, it could get very, very ugly between point A and point B. Again, using SPY TLT and these generic weekly moving averages as a proxy for the weight of the evidence, we can see here we have a full-bore bullish look still here for the most part. Blue, the fastest moving average, is on top, and the slopes of all of the moving averages over here, the bias, for the most part, is still up. From this point here to this point here, the model is already migrating away from growth assets because some of the evidence is already deteriorating. And we can see that here in these flat moving averages. This speaks to indecisiveness. Here the odds clearly favor SPY. Here they're mixed. So the million-dollar question is, what type of exposure would the model recommend between point A and point B to mitigate this blow here or this blow here? The answer is between October 9th, 2007 and March 9th, 2009. This is where the S&P 500 bottoms. This is where it peaks. The average weekly portfolio exposure to growth was 15.72%, and the average weekly exposure to defensive-oriented ETFs, and that can include cash, was 84.28%. These are averages based on the median weekly exposure to growth, 3.96% between point A and point B, telling us that the median weekly exposure to defensive assets was 96.04%. And obviously, this allocation fluctuates between point A and point B, but it's the average and the median that ultimately matters between point A and point B. What type of exposure did we have when things were really, really bad for the stock market? And then when the evidence improves, we can see this, measure it, and put it in a model. Blue is back on top. That looks a lot different than this period here, or this period here, or this period here. While every example in history is different, which means the future will be different, there are similarities. This portion here is easier than this portion here. The S&P 500 rallies, we get a counter trend rally here, and some of the data improves. But when the market starts to roll over again here, on a relative basis, this period here is much easier than this period here, and this period here is easier than this period here. Notice I'm saying easier. Nothing is easy. It's just the weight of the evidence here is clearly telling you that defensive ETFs are a much, much better place to be from a probability perspective. The data is more mixed here during the counter trend move in the S&P 500. And remember, we're looking at moving averages here for SPY relative to TLT. And like many of the charts that we show in these videos, with the benefit of hindsight, this looks relatively easy. This portion of the chart here, for the most part, looks different than this portion of the chart here. This portion of the chart here looks quite a bit different than this portion of the chart here. However, in real time, with volatility, negative headlines, negative signs on our screen, fluctuations in our profit and loss, and human egos being in the equation, in this type of environment, like all difficult environments, it's not the mathematical skill that's critical to winning. It's the discipline of being able to stick to the system. And another logical question that might come up: what happens if stocks and bonds fall in unison? How could that happen? A big spike in inflation could cause the next bear market. The model does not default to any asset, including bonds. Bonds have to clear mathematical hurdles. If the bonds can't clear the data-based hurdles, then the defensive side of the portfolio can be in currencies, it can be in cash, it can be in extremely short-term instruments, it can be in gold, it can be in silver. All of it is data-based, and prove it to me. Typically, though, maximum fear ultimately sees investors run towards defensive assets such as bonds. And in this case, between point A and point B, migrating to defensive ETFs and migrating away from SPY worked extremely well. This is point A here, October 9th, 2007. This is point B here, March 9th of 2009. This is the total return for TLT, or long-term treasury bonds, and this is the total return for SPY. We don't need to do anything fancy necessarily in a bear market. We don't need to short, we don't need to use options. Sometimes we can do very, very well in boring TLT. At this point here in the bear market, TLT is up over 40%, and in the same period, SPY is down roughly 40%. You can see here between point A and point B, TLT is proving itself with hard data. And I can't emphasize enough, it always looks easy with the benefit of hindsight. Not many things are easy in the financial markets, just as this quote applies between point A and point B. He demonstrated with facts in the August 10th, 2018 video that 2018 has been no picnic either. It's very, very easy to overreact to negative signs and scary headlines. And the hard data tracked by the model can help us limit the frequency of those common missteps. With the benefit of hindsight, it looks relatively easy to say, the long-term trend looks healthy here. This is the slope of the S&P 500's 200-day moving average. Here's the correction here. It starts here, and it basically ends out here somewhere. Once again, in 2018, it's not been the mathematical skill that's been critical to winning. It's the discipline of being able to stick to the system, which in real time is much, much harder than it appears when we're looking at these charts in the rearview mirror. When we get closer to an event like this from a probability perspective, see how this line is flat here and eventually price rolls over. We will most likely be covering these type of topics in here, getting ourselves psychologically prepared for the possibility that we might have to migrate. That's not what the long-term hard data says today, so we really don't need to cover it in excruciating detail. But it is important to know in the present day relative to sleeping well at night. We have to know that we have an exit strategy. And why is psychological preparation so important? Think about how long we were talking about common missteps and volatility between a point A and a point B before the 100% normal and to be expected correction that started on January 26, 2018. We covered the common missteps here on April 28, 2017, basically saying we know with 100% certainty, even though the S&P 500 gained 41% between point A and point B, there is going to be gut-wrenching volatility between point A and point B. Covered it again on July 14, 2017. If we cover it in advance and set proper expectations, we have a much, much higher probability of navigating between point A and point B when the inevitable difficult period comes. It's July 14th, 2017. Covered these concepts again on October 13th, 2017. Think about this quote here. A stock operator has to fight a lot of expensive enemies within himself. Cover this in October of 2017 when the markets are doing well, because we know that eventually easier markets are going to be followed by harder markets. This is October 13th, 2017. This slide here was covered on December 22nd, 2017. The market's doing very, very well on December 22nd, 2017. The trends are strong and the data looks good from a long-term perspective. Why are we covering these bullet points? Volatility is not the enemy. Volatility is 100% normal and to be expected. Odds say 2018 will be more volatile than 2017. We should mentally prepare for volatility, December 22nd, 2017. It's important to trust the hard data, the model, and our disciplined approach. It's important to take it day by day and go with the flow. Here's where we covered those concepts in late December. Covering them over and over and over again when things are going well enabled all of us, including the clients, to trust the hard data, the model, and our disciplined approach when things became very, very difficult. And when we fall back on the hard data and clients trust the data, the model, and our disciplined approach, that allows us to conserve mental energy and focus on the primary task at hand, which is managing all of our hard-earned money and all of our hard-earned accounts. And that includes Kathy's accounts and my accounts. And we are very, very appreciative to have an outstanding and very, very respectful and cooperative group of clients. All of us are part of the team here. And when every link in the chain is strong, it helps all of us. So how does this exact same chart look today after an admittedly difficult period? Here are the exact same generic weekly moving averages. We're not even disclosing which moving averages we're showing because we do not use these moving averages with this ratio. We're using this to illustrate basic concepts. It's helpful to look at price here. The S&P 500 peaks in here, and the low is made here, basically. So what did the facts in hand tell us here when the market was very, very weak? This little snapshot here, this, doesn't look anything like this, or this. So the hard data here, and this is a proxy for the weight of the evidence, told us to try to remain patient. It's not abnormal for a ratio or price to come back and revisit moving averages and test them. It's not unusual to drop below them for a short period of time. And then you can see here when things get a little dicey. Look where we are, though. Look where price is. The S&P 500 is well off of the February low when these moving averages tell us to pay closer attention. And we know that big moves come after tight clusters. Tight cluster, tight cluster, tight cluster. Big move, big move. Now we have a tight cluster here, except, unlike this period, now we're getting the moving averages. Blue is now back on top. All of the moving averages are turning back up simultaneously as price or the ratio breaks out of the consolidation box. This is exactly what we saw with the S&P 500 in 2016. This is a very constructive look here. The longer it holds, the more meaningful it becomes. This is telling us that we could be getting ready to have a big move again in this ratio. The longer a market goes sideways, the bigger the move we can expect to get. These are the charts that we covered in last week's video. These are generic daily moving averages, and once again, the model does not use these moving averages here to make any decisions. We said this chart here on September 6th, 2018 looked a lot more like these constructive periods. How does the exact same chart look on September 13th, 2018? The answer is still constructive and still telling us to keep a flexible, unbiased, and open mind about better than expected outcomes in the days, weeks, months, and years ahead. As always, we'll continue to take it day by day. And if we maintain that flexible, unbiased, and open mind, it will allow us to keep our ego at bay when the data starts to shift in a material manner, and it will allow us to shift from classifying volatility as volatility to ignore to classifying it somewhere in here as volatility to respect. And when we look at VTI, or the total stock market, this is a constructive look here. What once acted as resistance, may now act as support. The longer the breakouts hold above this point here and above this point here, there's another orange box we can draw, the higher the probability of good things happening. From a risk-reward perspective, this is an attractive look because there's all types of potential support below the market. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shravaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.